Yeah, so this is another big one. So there's a couple of big income tax considerations that you have to think about when you're setting up an irrevocable trust. It's going to be outside of your estate. And so the first big consideration is something called a basis step up. And so some of you might be familiar. So when you die, your assets, the assets that you own personally, get what's called a basis step up, which basically means any capital gain, any accrued capital gains are wiped out for capital gains purposes. So if you have a really appreciated investment property and you die, that appreciation for capital gains tax purposes disappears, and your children or spouse or whoever it is inherits the property with a basis equal to the fair market value. And so the ability to wipe out all of that accrued capital gain liability is very valuable. And so people don't want to give it up all else equal. If you're someone who is going to be over the estate tax exemption amount, or if you think you're gonna sell the asset during your lifetime anyways, because maybe you're 40 years old and you're gonna sell the property in the next 5 years anyways, then that basis step up isn't very important, or it's at least less important than the future gift and estate tax liability that you're gonna be facing. But you still wanna get the basis step up where possible, and so one way of having kind of the best of both worlds is you can gift an asset to an intentionally defective grantor trust or any type of grantor trust. So this includes IDGITs, but it also includes ILITs, Irrevocable Life Insurance Trusts, and also SLATs, which are Spousal Lifetime Access Trusts. You can actually gift an appreciated asset to one of those grantor trusts. The moment it leaves your estate, it'll no longer be eligible for the basis step up, but you can actually either buy it back or swap it in exchange for another asset in your name as a way of getting the low basis asset back into your estate before you die. Let's say I gifted, let's say I had a real estate, some investment property. I gifted it to the trust. 20 years later, it's worth a lot of money and it's very low basis, lots of appreciation. I might say, you know what? I have a lot of cash and bonds and stuff in my name that I have high basis, and that investment property has a really low basis. And so I'm going to swap out that investment property so that it's back into my name instead of the trust. That way, it'll get a basis step up when I die. And in exchange, the trust is going to get cash and bonds and other stuff with higher basis. And so it's a way of having your cake and eating it too. So you're able to get the growth from the investment property out of your estate for that however many years, but you're also eventually able to get that basis step up when you die.
I'm just one little pause for a plug. The point of this session is not necessarily to talk about Valor, since our role here is really in the planning and in the implementation of these trusts, not so much in deciding which assets, although we're of course available to consult and help you decide. But it's worth noting that the kind of swapping that Peter's describing is one of the parts of administration of these trusts that Valor excels at. We essentially automate the process of identifying potential swaps like this and facilitating them. It's something that you have to figure out makes sense, and you have to carry it out. And a big part of our value add across the board here is that we bring technology to bear on these questions and are able to automatically surface these sorts of valuation jumps and let you know, hey, a swap could make sense in this case. If you'd like to do it, let's do it with a click of a button. So just a little plug before I now pull up Tom's, I think, related question. Um,
Yes, whether an asset is in an LLC or not, whether it's single member or multi-member, doesn't affect the basis step up. An asset in a single member LLC, if you're the member, it'll still get a basis step up when you die. But an asset in a multi-member LLC can also still get a basis step up. You wouldn't get a full basis step up. So like if you own 20% of the LLC, if you're a 20% member and your friends are the other 80%, they're not going to get a basis step up for their 80%. But your 20% can still get a basis step up, even though there's other members of the LLC. So any asset that you own personally, whether that's an LLC membership interest or real estate or a partnership interest or whatever, it's still eligible for basis step up. So, and can the LLC be placed in a trust? The LLC can be placed in a trust, or your membership interest can be placed in the trust, but that does affect the basis step up.
We have an important clarification question that just popped up, Peter. Sanjay asks, what is basis step up? I feel like we unfairly make some assumptions about knowledge base here. So what is a basis step up? The idea here, for anyone who reasonably doesn't know the answer to that question off the bat, the idea is, so when you own a capital asset, an asset that's appreciated over time, your cost basis is essentially the amount that you bought it for, plus any investment you made in it. So you bought a house for $1, and you put $1 into renovating it, and then you sell it, and that $2 is not taxed, whereas all the growth is. So a basis step up means, as Peter said a few minutes ago, but I know there's a lot of text here and a lot of talking. So just to reiterate, the basis step up is when you die and an asset goes to your beneficiaries, your heirs, the cost basis jumps up to the value and that you die. And so people aren't paying tax on essentially all the value that accumulated during your lifetime.
Yeah, so there's another income tax consideration here, which is that certain assets are particularly well suited for trusts. And in general, income tax inefficient assets are very well suited for both grantor trust and non-grantor trust. So grantor trust, as I mentioned earlier, are trusts where the trust is disregarded for income tax purposes. And so that means that the grantor, the person who set it up, is on the hook for the income taxes. Non-grantor trusts are trusts that are treated as separate taxpayers for income tax purposes. And so why would you maybe want to put income tax inefficient assets into a trust? And so a couple reasons. So with a grantor trust, the more income tax inefficient the trust is, the investments are, the more income tax liability that the trust will generate, which means that the more income tax liability the grantor will be paying on behalf of the trust. But when the grantor pays those taxes, it's not treated as a gift for gift tax purposes, even though the trust is outside of the grantor's estate. And so it's actually a way to make additional gifts to the trust beneficiaries without those gifts being treated as gifts for gift tax purposes. And so if you had two assets and one of them was really income tax inefficient and the other wasn't generating income tax liability, let's say it's stock that just appreciates but doesn't pay dividends, you're probably better off putting the income tax inefficient investment like private credit or whatever into the trust so that you're paying off all the tax liability that the investment generates rather than putting the stock in the trust, which is going to appreciate, but isn't going to recognize income, which means that the trust beneficiaries or the trust itself are going to eventually have to pay that income tax liability themselves.
Definitely, I think the most esoteric
Yeah,
one
it's a
of
little esoteric, but the short answer is that it can be very efficient to put income tax inefficient assets into grantor trusts, and non-grantor trusts are separate taxpayers. And so if you're in a different state, you can put private credit. If, let's say you're in a high tax state like California or New York, you can put private credit into a non-grantor trust. That private credit probably won't have to pay state income tax so that the income won't be subject to New York or California income tax. And so that's a nifty way to avoid state income tax on an investment that's pretty tax inefficient.